Welcome to our Cost Segregation Software Tools and Tax Strategies webinar. Today's speaker will be the manager from our Chicago office, Sasha Branecki. We like to begin all of our webinars with a little background on our company. KBKG is headquartered in Pasadena, California, with additional offices in Illinois, New York, Georgia, and Texas. Since 1999, we have successfully conducted thousands of studies nationwide. KBKG's team has performed studies on facilities ranging in size from 10,000 to over 1 million square feet, resulting in the deferral of hundreds of millions of dollars in taxes. We also have highly qualified engineers and tax professionals on staff. Our engineering department has extensive construction experience in reading plans and utilizing RS means and Marshall and Swift cost estimation techniques. Our tax department provides support for all cost segregation tax-related issues, including 10-to-1 exchanges, AMT, passive activity, abandonment write-offs, and lease provisions. We are a preferred provider for thousands of CPAs across the country. Now, I'll introduce our speaker, Sasha. Sasha is a manager with KBKG, specializing in cost segregation and fixed asset services, overseeing the Midwest region. She has over 8 years of experience conducting cost segregation studies, Section 481A adjustment calculations, and fixed asset reviews, which include residential rental property, commercial retail, restaurant, office properties, and industrial manufacturing facilities. She has joined KBKG in 2015, and her responsibilities include project management, 481A technical training for staff engineers, client development and proposals, and recruitment. Sasha graduated from DePaul University in Chicago, Illinois, with a Master's of Science in Accountancy, as well as from the Illinois Institute of Technology in Chicago, with a Bachelor's of Architecture, with a minor in Construction Management. She is also a member of the American Society of Cost Segregation Professionals. Now I'll turn it over to Sasha to continue the presentation.
Welcome, everyone. Thank you for joining us this afternoon. We'd like to get started with some learning objectives for today's presentation. First of all, this webinar presumes that attendees have a basic understanding of cost segregation. I'm going to discuss briefly the benefits of doing a cost segregation study and mention some of the tax implications that you need to consider in conjunction with these studies. I'm also going to discuss some tax strategies and planning considerations that you may not be aware of. Finally, I'm going to discuss and demonstrate some new proprietary tools created by KBKG that allows tax preparers to generate deductions, value for your clients, and even potentially generate revenue for your company. Cost segregation has been around in one form or the other for decades, although many taxpayers and tax preparers are unaware of it. The IRS, on the other hand, is well aware of cost segregation and even expect taxpayers to perform these studies. They have published a Cost Segregation Audit Techniques Guide, or ATG for short, to assist examiners when auditing returns. You can view the entire Audit Techniques Guide on our website at the link displayed on this slide. The primary goal of a cost segregation study is to identify depreciable real estate related costs that can be depreciated faster, which is typically through 5, 7, or even 15-year recovery periods versus the general 27.5 or 39 years. The second goal of a cost segregation study is to identify the depreciable tax basis for each major building component that is likely to be replaced in the future. Examples of these would include the roof, windows, doors, bathroom fixtures, HVAC, and so on. When a component is replaced, tax preparers use that information to claim a retirement loss or a partial disposition deduction for the remaining depreciation left on the retired component. You may be wondering, what types of real estate transactions are good candidates for a cost segregation study? The most common type of analysis is for existing properties that are acquired by a taxpayer. In this situation, the depreciable portion of the purchase price is recovered over the appropriate recovery periods. Next is newly constructed property, which is property that was constructed and placed in service for the first time by the taxpayer. In this situation, the total capitalized cost of construction is recovered over the appropriate recovery periods. Many taxpayers also incur costs to remodel their existing properties, and depending on the facts and circumstances, end up capitalizing these costs as well. The last most common type of analysis is for improvements to an interior space. This typically includes analyzing costs for interior tenant build-outs within an existing building shell. You may be surprised to know that you can complete a cost segregation study on properties that were placed in service in a prior tax year. You can go as far back as 1987. However, the amount of depreciation can take on an asset is limited to that asset's remaining depreciable basis. So as a practical matter, it's usually most beneficial to focus on assets placed in service during the past 15 to 20 years. Let's take, for example, a $3 million retail building that's being depreciated over straight line over 39 years. The results of a cost segregation study might identify $330,000 of 5-year tangible personal property and another $360,000 of 15-year land improvements. Reclassification to these shorter recovery periods result in approximately $611,000 of additional deductions and an increased cash flow of $262,000 over the first 5 years. Just as a note, this example is using a property in California that is placed in service mid-year of 2020. Cost segregation is one of the most common tax planning tools that should be considered by anyone in the real estate industry. You can do this study anytime after the building is purchased without filing an amended return. You do this by filing a Form 3115 for a change in accounting method. This allows you to claim any missed depreciation deductions in the year you apply the study. So this is very important for tax preparers to consider. If you have the probability of a taxable event in a future year, you may want to delay the study until the year you are really going to need those deductions. Without the software tools we're going to discuss today, it would generally make sense to hire a cost segregation engineer when there is a depreciable basis of approximately $750,000 or higher. Otherwise, it's difficult to find enough benefit in the study to justify the fees incurred. For more information or for more updates on tax planning strategies for cost segregation, please see our updates that are posted at the link shown on this slide. Here is a list of some tax considerations you should be aware of when utilizing cost segregation. Depreciation deductions will reduce alternative minimum tax, or AMT. Bonus depreciation can apply to reclassified items in a cost segregation study of a newly constructed property and now also acquired property. Any unused deductions carry forward to future tax years. When a building is sold, the taxpayer or seller may need to recapture depreciation taken on the tangible personal property. Accounting method changes are addressed with IRS Form 3115, which means you can retroactively address buildings from prior tax years. Passive activity rules can offset the benefits of doing a cost segregation study. If the real estate activity is passive, then you must use the deduction against income that is also passive. 1031 exchange rules need to be considered. Typically, it's the net increase in depreciable basis associated with the replacement property that's the subject of a cost segregation study. Through tax reform, the 100% bonus depreciation rate is applicable for assets that were acquired after September 27, 2017, and it applies through the year 2022. It is then scheduled to reduce by 20% each year after that. The new law no longer requires that the original use of the qualified property begin with the taxpayer, as long as the taxpayer has not previously used the acquired property and the property was not acquired from a related party. The opportunity to take bonus depreciation on acquired property is a very significant benefit that taxpayers have not had before. Taxpayers that are considered to be in a real property trade or business must use the ADS system if they elect out of the limitation on interest deductions. However, this doesn't apply to businesses with less than $25 million in average revenue over the last 3 years. The ADS recovery is 40 years for commercial buildings and 30 years for residential rental property. The result of the mandatory use of ADS is that bonus is not available to the taxpayer. The definition of real property trade or business comes from section 469C7. Taxpayers electing out of interest limitations must use the alternative depreciation system recovery periods for non-residential real property and residential rental property. The good news is that this mandatory ADS requirement for taxpayers in a real property trade or business that elects out of interest limitations is specifically associated with these 3 types of real property. It does not apply to tangible personal property, so the 5 and 7 year property remains bonus eligible, even though ADS recovery periods apply to the real property categories I mentioned. Land improvements are interesting because we think of them as real property components also. However, this type of 15-year real property is not included in the definitions of non-residential real estate or residential rental property. Therefore, land improvements remain 15-year property and they are bonus eligible. Although the law states that acquisitions after September 27th of 2017 are eligible for bonus depreciation, there are certain written binding contract rules that disallow bonus depreciation if an acquired building went into contract before September 28th of 2017. For example, assume a taxpayer closes on acquired property on October 1st, 2017, but they entered into a binding contract on September 1st, 2017. It is likely that they are not eligible for any bonus depreciation on their used property. The final regulations provided some clarity on the acquisition date of used property acquired pursuant to a written binding contract. The date is determined to be the latter of the date on which the contract is entered, the date on which the contract is enforceable under state law, if the contract has one or more cancellation periods, the date on which all the cancellation periods end, or if the contract has one or more contingency clauses, the date on which all conditions subject to those clauses are satisfied. We advise our clients to consult with their attorney or tax advisor regarding the binding nature of such a contract, as this may directly impact their eligibility for bonus depreciation. In Section 754 Step Up, as long as there is a new partner coming in and the property has not been used by the taxpayer before, the step-up can receive the new bonus depreciation. A step-up upon death is specifically excluded from the new bonus depreciation where property is received from a decedent. Cost segregation can be a very useful tool in estate planning. For this strategy, let's start with some basic rules related to estates that involve real estate property. When a building owner dies and a property is inherited that has appreciated in value, any gains built up during the decedent's life are forgiven. The beneficiary receives a step-up, which means the property's depreciable tax basis is reset to the fair market value as of the date of death, and depreciation resets and begins again. Because of the step-up, there is a time-sensitive opportunity to apply a cost segregation study to the decedent's pre-stepped-up basis, which creates a permanent tax deduction. To illustrate this, let's look at a building purchased by the decedent in 2014, where the death happens in August of 2020. Since the original investment of $1 million is considered residential rental property, it is depreciated over a long life of 27.5 years. So, by the time of death, the decedent will have approximately $728,000 of depreciation that they were never able to deduct. The decedent's estate will still need to have a final tax return prepared for the period in 2020 that they were alive. Now, suppose the decedent had sold the property for $2 million before they died. This would have created a taxable gain of $1.27 million. That doesn't happen in our situation though, since the current estate tax rules forgive any taxable gains built up by the decedent. The beneficiary, however, gets a full step up to the full fair market value of the property on the date of death, in this case, $2 million. The beneficiary now records the $2 million basis on their tax return going forward. Now, most tax preparers already know that doing a cost segregation study on the $2 million stepped up value is a great idea. But many tax preparers overlook the time-sensitive opportunity to apply a cost segregation study to the pre-stepped up basis. This allows the decedent to claim even more depreciation deductions before death, lowering the building's tax basis and creating a higher step up to fair market value. The idea is to take as much depreciation before the death, since the heir gets a step up to fair market value, regardless of the decedent's basis. This strategy typically yields the greatest benefits for the estate, because these deductions would otherwise be lost forever if not taken on the decedent's final tax return. In our case, when the decedent's final tax return is filed along with the Form 3115, they claim missed depreciation deductions of approximately $174,000. As I mentioned previously, this lowers the decedent's building's tax basis, but that is okay since the heir gets to step up to a fair market value. Because these deductions would have been lost forever, the result is a permanent tax savings just over $68,000. Now, I mentioned that this needs to be done on the decedent's final tax return. This is because when a building is acquired in tax year prior to death, in order to apply a cost segregation study, a Form 3115 is required and generally cannot be filed on an amended return. From the heir's perspective, they now get to step up the basis to the current fair market value and begin depreciation all over again. And since they've already had a retroactive cost segregation study done on the property, they can now have the study updated to reflect the new fair market value step-up basis at a minimal cost. This allows the heirs to maximize deductions on the new basis. Now, we're going to shift gears and discuss some of the proprietary software briefly mentioned here earlier. The residential cost segregator was created to provide tax preparers with a tool that allows them to prepare a cost segregation report on smaller residential properties without the need to hire a third-party cost segregation engineer. By using basic information and allowing the building owner to fill out a simple survey regarding the property details, our software provides a detailed cost breakdown for the property that is categorized by tax recovery period and can be used for income tax depreciation purposes. This is accomplished by using empirical construction cost data and proprietary algorithms written by the KBKG cost segregation engineering team. Most of these reports result in substantial deductions, and honestly, for some taxpayers, they are pretty sizable. The bases for these properties are lower and the properties are smaller, but understanding the type of taxpayers that they are likely investing in these properties, the results could be quite significant, especially once it is compared to the cost of the report, as you will see very soon. It can provide a tremendous value since they are designed in a way that is easy to use. It takes less than 15 minutes of time to prepare, and it is a tool for tax preparers that is set up in a way where they can pass the questionnaire along to the property owner to fill in. The property owner can fill out the facts and do some of the legwork, and it will come back to the tax preparer pretty much ready to the point that they just need a quick review. Call it a sanity check before they hit the button and actually generate a report for themselves. It is a white label report, meaning that there are no KBKG logos anywhere. So the tax preparer can put their own logo and really provide this as a value-added service for their clients. It's something that they can even present to their client as another service offering, along with maybe the compliance and tax preparation work they are already doing. It comes with our free audit support, so KBKG stands behind the work that we do. They are simplified so they can be easily uploaded into our 481A calculator as well. You can print them out in either PDF or Excel format, as I will show you in the live demonstration coming up. And as I mentioned, we do see tax preparers or CPAs charging upwards of $1,000 or even $2,000 of their own professional service fees associated with putting these reports together. That's the cost of our report and some of their professional fees to do some of the work. It is a very cost-friendly way for properties south of that $500,000 depreciation basis level. We always recommend 3 steps when considering the residential cost segregator. First, go to the website, look at the product, and estimate the potential tax savings for your client for free. There is a little estimate box so you can see if this is even worthwhile for you. Then, if you're interested in pursuing, you can send that survey link to the building owner to fill out the property details. It comes back to you, and the person who initiated it comes back to the person who initiated the survey link. You get to review the information, and you get the final say to actually pull the lever and generate the report and use up one of your report credits. Then you will have a cost segregation report complete with all the details that you need to implement into the return. Lastly, this is optional if the property is a prior year acquisition. You have the ability to upload straight to our 481A software to calculate the catch-up deductions I was mentioning before. So first of all, you'll come to the KBKG website, and wrong button. You'll come over to this software. Jackie, is my screen sharing pausing or no?
I see you hovering down the software menu.
Okay.
It's not paused.
Okay, cool. So you'll come over to this software dropdown, and you will click on the residential cost segregator. It will bring you to a page where you can easily create this preview, and I will give you an example. So let me type in quick address. We'll use an example of $500,000. We'll say it's a purchase date of July 31st, 2020. Here you can change the ROI percentage and which tax brackets you are here. And in this example, we'll use a tax return year of 2020 as well. Again, actually, this decided to error out. Okay. And then since it is past the September 27th, 2017 date, this acquisition example is bonus eligible, so we click yes. Here you get to select the bonus depreciation percentage, and you can hit the preview tax savings. Here it'll generate a quick results page for you to view. This is a little tiny. Let me zoom in. And this will tell you, what you could expect for additional tax deductions for the first year. And in this case, it's about $63,000 to about $94,000. And you can focus again on the additional tax deductions for the first 5 years, which is about $53,000 to $80,000. And it can also tell you, based on those percentages that we entered in on the previous page, your net present value after tax. So if you think that this will be beneficial, of course, you can drop down, and it will actually bring you to this button here. And when you click this, if you haven't entered our system yet, it will let you set up a free account and get started to actually use the RCS. Before we leave this page, you can also download preview of the tax savings from this calculation. So if we were to click this create free account, and once you do, it'll bring you to our KBKG Solutions website. And this is a basic view of what you'd be able to see. You would be able to come over to the apps and select the residential cost segregator. Here, this is how this page is set up. So it'll show you all of the previous RCSs that you may have generated. Across the top, it'll show you how many credits you do have left. Here you can purchase them. As an example, I'll create a new report. And this is what will show up if you're starting for the first time. Any tax preparer can come over to this link and hit the send invitation link. Here you'll enter the recipient's name, the property owner. You can change the subject, any part of the message, and then you can hit send email. Now that email will go to the person to fill out, and when they do fill it out, you'll get a notification and it'll bring you back somewhat to this page, but all the way on the 5th tab here, and it'll be filled out, like all of these fields will be filled out. Now, I'm going to do it based on completing it for the first time. So using the example from before, I'll enter the address. We'll enter in the depreciable tax basis. This, of course, is purchase price less the land value. So again, we'll use 500,000. We'll put the acquired date, which was July 31st, 2020. And here you'll select the type of structure. That preview page didn't allow for the different types of structures, residential units. So you do have this option here, and we'll select a residential 6-unit. Number of stories here, and you can enter in the building square footage. We'll use 5,500 square feet. Then you can enter in how much the overall property size is. So we'll use 7,000 in this case. Now this is starting to ask more questions about the building itself. So what are the exterior walls made out of? Again, you have a drop down, and we'll pick wood panel. Does this building have a basement? If it doesn't, you select no, or you have the options of a finished or unfinished basement. We'll select no in this case. Now, the construction quality. You may be wondering what that actually means. Here, you'll be able to hover over any of the fields that have a question mark next to them, and it'll give a brief description of what this means. So this is the quality of the materials that the building used when it was created. So we'll say average. Physical condition, again, what condition the building actually is at the time of purchase. Again, we'll say average. So here, this tab is complete. You should be able to hit save and continue. Now, I'll quickly fill in, some of these. So it's the number of bedrooms. We'll say 8, for example. Number of bathrooms, one per unit. Does it have fire sprinklers? No. Now, the next part is flooring type. This is where you will get to choose the different types. Again, it ranges between laminate flooring, some vinyl tiles, or even vinyl sheets, maybe ceramic tiles under here. Maybe it's hardwood, carpet, or other. So for the kitchen, I'll use tile. Bathrooms, again, I'll use tile. Family living room, I'll leave it, or I'll change it to vinyl tile. Dining room, the same vinyl tile. And then for the bedrooms and hallways, I'll choose carpeting. Now, you can leave these as not applicable if, of course, they don't apply. Next is the HVAC unit. So since this is a California property, we're going to assume that there's really only cooling in terms of HVAC. You'll select your HVAC type, either a central system or an in-wall unit. We'll use an in-wall unit. Number of ceiling fans, we'll say 6. Window treatments, we'll do horizontal blinds. Next section is about some of the appliances you might see in a typical unit. So we'll select, dishwasher, a range with an oven, the refrigerator, and a garbage disposal. Again, you'll hit save and continue, or if you wanted to go back, you can hit this button or hit one of the tabs above. So for type of parking garage, you do have the option of whether there is one, if it's attached to your building or not. We'll say not applicable. So this section will gray out since you selected not applicable. And then we get to choose, how many outside parking spaces you have. We'll say 6, since there are 6 units. Next section is the site improvements. We'll say based on the square footage of the, site, there's really only landscaping. But if you do have a deck, a patio, or pool, of course you can choose those. Lastly, in this section is walls and fences. You'll just need the length of what these are. So we'll say that there's a concrete wall in between you and another property, and we'll select a wood fence that there's 25 feet along the back wall. Now, we'll hit save and continue, and it'll bring you to a page about those percentages that we talked about, the return on investment factor, and the combined federal and state tax rate. So we'll leave those the same as our preview example. Our tax return year, we'll select 2020. Here you get to decide whether or not ADS is applicable for your longer life property, and if bonus depreciation is applicable, and we'll say yes. It'll drop down and show you which bonus depreciation percentage you'd like to select. Now, here I'm going to bring you to the page again, if you were to send out that survey, it would come back to you in this format. So you'd be able to look this page over and see, maybe they put that, there's, 12 bathrooms, or no, maybe like 20 bathrooms. And of course, that's not the greatest example for this many, but they might have entered in a wrong amount, and this is where you could easily review that information. Now, there is a note at this top. So, you want to make sure that, this is accurate, because once you select the calculate button here, you will use up one of your credits. So I'm going to click this, and it's again going to give you a message. So you'll have 30 available. You have 30 available. And I'll have 29 once I run this. There's the disclaimer. I would click I agree, and then proceed with calculations. So the results pop up right here in a quick, easy window. On the top, again, you can see the additional tax deductions in year one. They were $125,000 once we completed this RCS. Going back to that preview, it was only saying that there was $62,000 to about $94,000. So it does come up a lot higher. And again, you know, your additional tax deductions in years 1 through 5 is $106. And again, looking back in the preview, it was only $53,000 to $80,000. So this page will show you, you know, all of those values. A quick little chart over here. It'll give some basic information, you know, the date acquired, your tax year, how much the tax basis is, and your bonus. If you keep scrolling, here is where you get the bulk of the information. This is splitting up the property into those multiple components. Over here, you have your building systems, so your structure and interior, your plumbing, HVAC, electrical, and so on. It will make those estimates for you, allocating the purchase price cost to that $500,000 that we entered. It'll list out the year of, that is its life, how to depreciate it, and it'll show it into the multiple sections. Again, once you go lower, it'll show the property details and all of the items that you entered into that survey. Here, you'll be able to save it as a PDF, export it to Excel, or if it is a prior year property, you'll be able to, and if you want, you can use the 481A adjustment calculator that we have on our website. So if you would select Save as PDF, it would generally generate, I believe, a 3 or 4 page PDF. I don't think that it's actually working for me right now. No. It'll populate a 3 to 4 page PDF, and that can be used as your support. Now, say if you were to need the 481A adjustment, you would be able to click this page right here, or that button right there, and it will automatically populate some of these fields. Now, we use an example of a 2020 property, or acquired property. So I'm going to change a couple of items here, but you'll be able to enter in, you know, the entity name, the EIN or Social Security of whoever's tax return this is going on, the tax year end. So again, it'll be December 31st, 2020, since we're putting it on that tax return. Again, it'll show your tax rate and ROI factor. We'll change this to a prior year. We'll say it's only a year old, same date, but for 2019. Here you'll be able to enter in how much accumulated depreciation that you've had on the property. That will show up on your depreciation schedule. You can enter in your AMT if necessary. Select how it was depreciated previously. So this is a residential property, so it's 27.5 year mid-month. Back then you didn't take any bonus depreciation. Again, here it'll break out all of those components into a little summary. You'd be able to hit calculate, and here is another window that shows this 481A calculation. I believe it's a little small, but up here on the right-hand side, you have your adjustment number. A negative number is a favorable number, just so everyone knows. And these 8 buttons on the top will give you supportive material and show the calculations on how this adjustment was done. I'm now going to go back to the PowerPoint slide. So here are some examples that you can use or that you can view to see how each one would relate in the residential cost segregator. And again, some examples. Now, let's talk about retirements and partial dispositions. The current regulations allow you to take a loss deduction when you remove components from your building. So for example, if you paid $50,000 to replace all of the HVAC units in your building, you will need to capitalize that amount and recover it through depreciation over 27.5 or 39 years. You'll also want to figure out how much of the old HVAC was not fully depreciated and claim that amount as immediate deduction in the year this occurs. In the subsequent slides, I'm going to show you a tool that can be used to figure out the value of any building component without having to do a cost segregation study. I want to go through a case study to show why it's important to figure this value. Looking at an example to see this impact, suppose a taxpayer acquired a building 3 years ago for $5 million. This year, they spent $1 million to remodel part of the second floor. So this could be ceilings, walls, lighting, plumbing, HVAC. We can analyze the original cost of the demolished components and discover that it represents about $470,000 of original $5 million building basis. The taxpayer can now recognize a loss of $430,000 in the current tax year, which is the original cost basis less depreciation already taken. Remember, you can only take advantage of this partial disposition in conjunction with a timely filed tax return. Otherwise, you forego the opportunity to recognize the retirement. Based on final disposition regulations, there are a couple of ways you can determine the remaining basis. And if you've had a cost segregation done, which has already identified the basis in the component, then you're already set, or you are set to calculate how much depreciation has already been taken and what the remaining basis of the component is. But if you don't have a cost segregation study, there's a way to calculate it using the producer price index. You can discount the current replacement cost, new, of the asset back to the date the asset was placed in service. If the asset was not new at the time it was placed in service, then an adjustment needs to be made to recognize the asset's condition. However, a word of caution, this method can only be used for restorations, not for betterments or adaptations. KBKG has created an online partial disposition calculator that's available at the link shown on the slide. So for an example, we're going to use a building that was acquired 3 years ago, and the owner spent $200,000 to replace aluminum windows this year. We can use the PPI index to discount the current cost of the windows back 3 years. So we'll need to make an adjustment to recognize that the windows were not new when the building was acquired. So we'll have to consider the normal expected life of aluminum windows, which is 20 years. And since we replaced the windows 3 years after acquisition, we might assume the windows were effectively 17 years old. An appropriate condition factor using this rationale is 27%, which results in a value conclusion of $50,000 for the windows at the time of acquisition. Now we'll move to a quick demonstration of our partial disposition calculator. And if you come back to the KBKG website, you'll be able to hover over the software drop-down menu again. Select the partial disposition calculator. Here, you'll also get the opportunity to do a preview of, using this calculator. Now, if you were to come back, again, if you have an account with KBKG, you'll be able to come back to the Solutions website, select Partial Disposition Calculator, and to go along with our example on the slides, using the aluminum windows, we're going to say the cost of new component is $200,000. The date of the replacement, we'll use January 16th, 2020. The building cost basis, or the taxable basis, again, is the entire building. So we'll say $5 million. The date of purchase of the retired component or the building. Again, we'll say that since you bought it 3 years ago, it's January 16, 2017. The year in here, this is optional, but you can put the year the building was originally constructed, say 1985. Here, you'll enter in how much accumulated depreciation was entered in for the entire building. I'll use $379,000. Again, you can enter in the accumulated depreciation for federal AMT as well as state and state AMT here. Drop down, and based on the timing, it'll show a PPI index at the time of purchase of 195.4. Now, to select the component, you can either search for it or select the type of component. We'll come down to doors and windows, and we'll select aluminum windows here. It populates the normal life of the replacement component here. This is saying, how much how old the building was at the time of purchase, and then the number of years used prior to retirement. So we're saying, if the normal life is 20 years, that the effective age of the component is already 7. You'll be able to, so this is only a few fields to fill out. You'll hit calculate, and here are our results. We have the adjusted cost of component that's not adjusted for condition. So that is $188,000. Then we have the accumulated depreciation on the replaced component. In this case, it is, zoom in a little bit, about $4,500. And then we can see that the PPI adjusted cost of the component removed here is factoring the condition. So that is, $60,000. And that is affected by the effective age of the component. What we get is to take the condition adjusted cost here, the $60,000, less the accumulated depreciation for the asset. And below down here is the regular federal tax deduction. This is our deduction. So it comes out to about $55,000. You can click the PDF button that turns the calculation into a document that you can use as your backup support. Here is a quick example. The numbers are slightly different than what I just used in that quick demonstration. Now that we're at the end of things, I think it's important to mention that there are significant differences among cost segregation advisors in the marketplace. Sometimes taxpayers aren't immediately aware of how those differences may impact their experience. It's important to use an ASCSB certified member to oversee the analysis. Ask to see the resumes and bios of the key people who are actually involved in completing the analysis. Do they have experience and credentials necessary to produce a compelling and credible report that the IRS will accept? Some other items to think about when evaluating the company that you may choose are they willing and able to support you if your study was to go under audit? Will they charge you for that audit support? Or will they stand behind their work and provide free audit support? Does the advisor demonstrate thoughtful leadership in the marketplace? Are they up to date with current tax law and trends? Are they aware of property tax issues, energy tax incentives, repair versus capitalization regulations? Make sure that you choose a firm you can trust to help you maximize the tax benefits of owning real estate. There are a few extra slides in the webinar slide deck available to you that describe additional services that KBKG has to offer. Please look them over and of course reach out to us if you have any questions or you think we can help you out.
If you have any questions about the material that was covered or would like to discuss an opportunity, please give us a call. KBKG also offers other webinars that may be of interest to you. I invite you to check them out at kbkg.com/webinars.